warm welcome to everybody joining us today from different time zones across the world. Today's webinar on nature related risks and opportunities, financing nature positive climate action in emerging markets, is organized under the aegis of Climate Week New York and is a joint initiative by Octus ESG, Association of DFIs in Malaysia, that is ADFIM, Association of DFIs in the Asia Pacific, ADFIAP, and IORA Ecological Solutions. The increasing scale of degradation of the natural world is a cause for concern for financial institutions globally, as they're deeply intertwined with the natural world, both through their investments in nature dependent sectors such as agriculture and the physical assets that they finance that are vulnerable to climate driven disasters and resource scarcity. The collapse of natural capital represents a grave risk to financial stability as nature related risks reverberate through investment portfolios and lending books. Therefore, the aim of today's webinar is to drive fruitful conversations on critical barriers and enablers in integrating nature related considerations in decision making at the policy and financing level, with the ultimate aim of accelerating capital towards nature positive sectors in emerging markets. To begin with, a quick introduction of today's organizers. ADFIAP is the focal point of 90 development banks and other financial institutions in 40 countries and territories in the Asia Pacific. It aims to scale sustainable development through its members. ADFIM is a unique combination of development financial institutions and entrepreneur development organizations. With a membership base of 17 institutions, ADFIM aims to promote synergy and collaboration in the development finance and banking industry in Malaysia. IORA Ecological Solutions is a leading organization specializing in environmental sustainability, offering expertise in ecosystem management, carbon markets, nature-based solutions. Through innovative projects, IORA fosters climate resilience and biodiversity conservation across various landscapes. Octus ESG is a global firm providing strategic advisory and enablement on sustainable finance, climate transition, ESG, and climate risk management to the banking and financial sector. The organization stands at the intersection of finance, investments, and sustainability and has been awarded marquee projects by governments, multilaterals, and financial institutions. Now, a few quick announcements before we start. We have an exciting lineup of speakers, so I would request each speaker to please limit and observe the prescribed speaking time. For the participants, please key in your questions in the Q&A box on the screen, and the moderator would take them up suitably. In addition to Zoom, this event is also being live streamed on ADFIM's Facebook page. I would like to extend a warm welcome to our esteemed speakers joining us today. We start with Mr. Enrique Florencio, ADFIAP's Secretary General. He has over 15 years of experience in ESG and works with ADFIAP members to enhance ESG standards, promoting financing for sustainable and socially responsible projects. Could we please have his video?
Greetings, everyone, and welcome to our webinar. We are delighted to have you join us today as we delve into a crucial topic for our collective future. As we explore the pressing nature-related risks that emerging markets in Asia are facing right now, such as the alarming statistics that approximately 1 million species are at risk of extinction due to habitat loss and climate change. We will also highlight the tremendous opportunities that arise from financing nature-positive initiatives. These challenges threaten biodiversity and pose significant economic risk, with estimates suggesting that failing to address these issues could cost the global economy up to $23 trillion by 2050. This session will discuss how targeted investments in sustainable practices can drive resilience and foster economic growth. For instance, the Global Commission on Adaptation reports that investing $1.8 trillion in climate adaptation could yield $7.1 trillion in net benefits by 2030. This is a clear illustration of the potential financial returns from nature-positive strategies. Our experts panelists will share insights on successful investment models and case studies that showcase how proactive measures can lead to sustainable development and community well-being. Your engagement and questions are invaluable, so I encourage you to participate actively. Let us transform risks into opportunities and create a sustainable future together. Thank you for being here, and let's get started.
The video. Moving on, we have Mr. Mohammad Prasad Hanif, Secretary General of ADFIM. Mr. Prasad boasts 18 years of national and international success in project management, business development, and human capital development. As ADFIM Secretary General, he directs innovative products and promotes financial inclusion across Malaysia. Could we please have his video?
Assalamu alaikum and a very good day, everyone. First and foremost, I sincerely apologize for not being able to attend this important event in person today, as I am currently attending a course. However, I am fully confident that today's session will be immensely valuable, especially for ADFIM members and other participants. This webinar, focusing on nature-related risks and opportunities, financing nature-positive climate action in emerging market, comes at a very crucial time. The global natural crisis, driven by factors such as deforestation and unsustainable resource extraction, presents a significant challenge to both our ecosystems and economies. The discussion today will be pivotal in sparking innovative ideas and strategies for tackling these issues, and particularly in climate nature financing. I hope that today's exchange of ideas will inspire new approaches to integrating nature. Let us take this opportunity to explore how we can drive capital towards sustainable nature-positive sectors, which will be crucial for securing our environmental and economic futures. Once again, I wish all the participants a fruitful discussion, and I look forward to hearing the outcome of today's events. Thank you very much.
Thank you. Next up, we have Vidya Soundarajan, Senior Vice President at IRA Ecological Solutions. Vidya comes with 25 years of experience in sustainable development, climate change mitigation and adaptation, public policy, and natural-based solutions. She has spearheaded extensive adaptation programs across many regions, including South Asia, the UK, and the EU. At IRA, Vidya drives significant environmental projects and initiatives, including on risk mitigation, management of diverse funding portfolios, and cultivation of high-level partnerships and government relations. Over to you, Vidya.
Thank you very much, Harshali. First of all, thank you for having me over. It's a great pleasure to be here, to be able to share our views coming out of several years of ground level work. Specifically, I would like to focus a lot more on looking at risks and climate and environment risk from three perspectives. This comes out of one of our work that we've been doing in South Asia across climate resilience to identify what are the ways and means in which the businesses, the private sector essentially can contribute and start addressing climate change. And we see there are essentially three pathways. One is the climate risk to business continuity. The other is the direct impact on natural resource itself. If the private sector, if the business is dependent on natural resource. And a third very interesting perspective, and which is where I would like to focus a lot more on today in the brief 2 minutes, is looking at risk as an opportunity and as a much needed intervention, looking at the urgency of climate change. At the ground level, from a nature-based solutions perspective, what we would like to position to all the experts that are there in this meeting today, this event today, is the combination and the ability for emerging markets in South Asia to actually bring together both mitigation benefits as well as resilience dividend. When ground level nature-based projects and nature-based carbon sequestration projects and those investments are made on the ground, the slew of dividends in the form of community benefits as well as conservation benefits and biodiversity benefits as well as long-term natural resource security benefits that comes in the portfolio of offering for every dollar spent on mitigation essentially works as the most foundational argument that I have followed when I have been designing projects such as or implementing programs such as climate proofing, growth and development in Southeast Asia. Which is where we did analyze this. So moving forward, I just wanted to position here to all the DFIs and the following discussion and the esteemed panelists that we have to start looking at South Asia from an opportunity where every part of the climate finance focusing on mitigation essentially has the opportunity to provide adaptation benefits, conservation benefits, and direct people and prosperity benefits. So that's how the nature-based industry or industries related to natural resources can potentially operate in India, in Southeast Asia, South Asia, which is a very agrarian and allied industry-based economies. I would like to close on that to say that at two levels, we need to look at this as opportunity. One is identifying resolutions to these risks, identifying solutions and technologies and nature-based solution to essentially reducing the impact of climate risk is certainly an opportunity where private sector can come up with solution. The other end is also the fact that mitigation and climate finance investment actually gives you a portfolio of wider benefits when invested in this region. So I would like that to be the piece of background learning that we've had from the ground to share here. So thank you very much from IORA and the partners that we have had the opportunity to hear from all of you on the perspective of climate risk resolutions. Thank you.
Thank you so much, Vidya. Next up, we have Namita Vikas, founder and managing director of Octus ESG. Namita is an award-winning senior business leader with over 33 years of global experience. Her experience in sectors across banking, finance, and technology has led to launching several first-to-market green and sustainable wholesale and retail banking products. At Octus ESG, Namita has led impactful projects across emerging markets awarded by governments, UN agencies, and global DFIs. Over to you, Namita.
Thank you very much, Harshali, and a very warm welcome to all the speakers and participants. This is the third year that Octus ESG, along with its partners, is undertaking these important conversations under the aegis of the Climate Week in New York, and I'm glad to join in from New York. It's 4:12 a.m. in the morning, but happy to be here. And yes, indeed, as we heard from the other speakers, these are very, very important topics. There is a high importance that is being given to nature-related financing, and we are seeing those kind of conversations. Of course, data shows that over 50% of the world's economic output is dependent on nature and its services, amounting to about $44 trillion of global economic value generation. And nature has been a key concern, and the creation of global alliances like the Task Force on Nature-Related Financial Disclosures, which is backed today by 320 corporations and financial institutions over 46 countries, is a proof that elements like biodiversity and water will have a negative cascading effect in the future. Vidya just highlighted, the climate-related financial risks that are emerging, and this needs to be therefore addressed in a standardized manner, overall enhancing the accountability, monitoring, and deployment of capital flows to adaptation projects. And I would like to bring in an interesting example here to contextualize it to financial community. Bloomberg and the TNFD analyzed about 10 companies and mapped the financial cost of their nature risks. It found that 3M, the American chemical manufacturer, or the famously known yellow post-it that we know, that we use regularly, they incurred liabilities of over $10.5 billion for polluting waterways and with synthetic chemicals. And the company faced a 66% decline in share price between January and October of 2023 due to liability concerns. The total cost of remediation and other solutions is estimated to be as high as $25 billion. I think such instances are making financial institutions, bankers fast realize that the negative impact of nature or climate-related financial risks through business operations are eroding balance sheets or stock prices, and resulting in heavy penalties or reputational risks. Additionally, these also are driving down the asset value, affecting borrowers' cash flow. So the whole math is not going to be right going forward. It's impacting the income of the borrowers, the collateral, leading to higher probability of default. And all this is translating into substantial credit risk. So it's no longer in the realm of just climate or peripheral issues, but this is now becoming mainstream balance sheet related issues where credit liquidity risks are emerging for bankers, investors, and other economies. And therefore, what we are seeing, the trend that we are seeing is that many financial institutions are withdrawing credit to certain sectors or geographies, possibly amplifying the initial shocks brought on by climate change. The negative feedback loop is leading to further barriers in mitigating or adapting to climate change. So it's kind of a double whammy situation that we are facing today. And while there is a constant chatter about the need to scale nature-related investments to safeguard existing assets and protect future businesses, currently this figure remains in the zone of about $133 billion, leaving an estimated deficit of about $400 billion against, annually. So annually, about $536 billion are required to protect nature, but there is a deficit. And what we are seeing is that the scale that we require to bring in, which will come in from public and private sector, these kind of investments are most thought about as the domain of the public sector, and therefore, on account of high risk perception, long gestation periods, on account of a kind of long-term investment, which has a mismatch with what short-term horizons investors and bankers look at. And on the other side, the risks are yet to be understood. They continue to hinder the capital flows, given that these kind of investments, also have high uncertainty. And I think barriers, if I may just quickly mention here, regulatory and policy gaps, I think that needs to be a common framework, a unified, comprehensive guideline for nature-related investments is missing. The nascency of the non-financial disclosures, despite TNFD, there is no specificity on nature. Data access, accuracy, inconsistencies around data makes these projects unbankable or unviable, right? And I think that is something that at a government level, at an institutional level, a systemic institutional level, these aspects need to be really looked into. I think we have a fantastic lineup of the panelists, and we will dive deeper into solving some of these, or what could be the mechanisms. We have government representation, we have industry, we have the think tank representation, and I'm really looking forward to this panel discussion. So I will hand it back over to Harshali, and before diving into the panel discussion. Over to you, Harshali. Thank you very much.
Thank you, Namita. As Namita mentioned, we have a great lineup today. First, we have Charlotte Waldroff, advisor of sustainable finance at GIZ, the German development agency. Having started her career in financial markets at BNP Paribas, she joined GIZ in 2020, and since then, she has advised governments in Germany, Peru, Vietnam, and Indonesia, especially focusing on taxonomy development. She now leads a public-private partnership focused on scaling financing for nature-based solutions in Mexico, Peru, and Kenya. Next, we have Abhishek Acharya, Director, Ministry of Environment, Forestry and Climate Change, India. He is an officer of the Indian Economic Service, serving the government of India for 16 years. He has participated in the UNFCCC COP24, COP25, and COP26 as a climate finance negotiator from India. He is a postgraduate in economics, specializing in environmental economics and international economics, and previously also served as the Deputy Superintendent of Police in the state of West Bengal, India. Next, we have Matthew Newman, an investment manager at ISF. He supports the investment team in designing and structuring innovative development finance solutions through financial market, legal, and stakeholder analyses. Previously, as Vice President at Impact Investment Exchange in Singapore, He was responsible for overseeing the firm's transaction advisory business, managed over 15 impact-focused transactions across various industries in South and Southeast Asia. Then we have Kavita Sachwani, a chartered accountant and sustainable finance specialist with over 20 years of experience in sustainable finance, financial services, and policy advocacy. Currently, as part of the global leadership team at UNEP-FI, she focuses on embedding the principles for responsible banking with expertise in circular economy, pollution, nature, and biodiversity. Previously, she drove innovative financing and circular water economy initiatives at the World Bank's 2030 Water Resources Group. Next, we have Larissa Stiembhatia, the program lead for nature-based solutions at TMG Research. She leads diverse research teams and projects related to ecosystem-based climate adaptation and sustainable land management, with a focus on nature-based solutions to climate change across Asia, across India and Africa. She draws on vast field research experience in Burkina Faso, Benin, Rwanda, the Democratic Republic of Congo, Kenya, and India. And finally, we have Lachlan Cameron, the director of the Green Finance Center at Finance in Motion, as a leading impact asset manager with over a decade of specialist experience in generating positive change in emerging markets. He supports origination and mandate development of green assets as part of the investment management team. Welcome, everybody, and thank you so much for joining us today. And without further ado, let's begin. Over to you, Namita.
Thank you very much, Ashali. And we have all the speakers prior to me speaking highlighted the fact that there is a deep necessity of significant change within the larger investment landscape and the need to scale up capital towards critical nature projects. And the aim today is to dive a little deeper to explore that, and welcome to all the panelists. My first question is to Charlotte. Charlotte, GIZ does substantial work in building capacities for sustainable and developmental initiatives. And what we would like to ask you is, what are the key factors that make nature projects bankable from a agency perspective like GIZ? And what are the elements do you think project developers need to do better to structure these initiatives so that they can attract more investment? Over to you, Charlotte.
Great. Thank you, Namita, and thank you for the invitation to participate in the panel today. It's a great pleasure. So GIZ is the German development agency, and we provide technical assistance and capacity building on various topics, but also on nature finance. And we think of nature finance in two ways, really integrating nature-related aspects into financial decision-making, but also helping to mobilize capital for nature projects. And we work at multiple levels. We work with ministries and regulators on the development of policy and on the implementation of that policy. And then we work on a micro level with financial institutions, with companies, producer associations, protected area authorities, just to name a few. And the access to capital in a lot of those conversations and collaborations is a real issue. I don't think it's necessarily that there is a lack of capital. It's just sort of connecting financiers with the project developers and making sure that there's a mutual understanding. On the project level side, I think one important factor is the diversification of business models. So nature-based solutions, as has already been mentioned, have this great potential to provide multiple benefits, and therefore also a great potential for diversification and different income generating and cost saving mechanisms. And a diversified business model can help a project, and then also in turn the financier, safeguard against market shocks. It can increase overall returns, which is often an issue with nature-based projects, and can also help provide stable revenue streams over a longer period of time. So one example would be an agroforestry project that not only issues carbon credits, but also can rely on the sale of agricultural products. And then I think another aspect that's important for bankability is building up a commercial track record. So many investors don't necessarily disclose the minimum number of years that they require from their investee companies, but being able as as a nature-based project or company to show a track record really helps investors better assess the risk and the bankability of a project. And then third, I would say it's very important to leverage grant financing and public financing in order to attract commercial capital. So a lot of these projects already have standing relationships with either the public sector or with foundations, and are very much grant-based. But that grant funding can be used to sort of strategically become more bankable, whether that means building up a proper risk management system, having an impact measurement system in place, or developing and then ultimately presenting the business case. And then for this presenting of the business case, I would say one final criteria that is important to consider is building up relationships with the financial sector in that sort of pre-investment stage, because there's a real language and understanding gap between the financial sector and nature-based projects, and having a long sort of engagement period where both sides can better understand one another is very important also for the project to really get an understanding of what the investor is looking for and being able to build up the business case in order to become more bankable. And one final thing on that engagement period, I think also the public sector and companies like GIZ can play a real role to sort of help this coordination and help build those relationships.
Great. Thank you very much, Charlotte. I think that ecosystem creation is extremely important, and you very rightly said that it's not that there's lack of capital, but the project pipeline is many a times a question mark, which I have also seen as an ex-banker. I think policies play a large role in facilitating or fueling a market, and we've seen that with renewable energy pivoting towards now more of electric e-mobility and green hydrogen. And that gives me a good lead to go to Abhishek. Abhishek, the Government of India, the Ministry of Environment, Forestry and Climate Change is working on the National Adaptation Plan, and the key element is finance and policies, I believe, would be, I was a part of that session that you did where policies would look at financing in a big way. Climate adaptation and resilience has become a key priority for the minister, and much of the adaptation initiatives are under the remit of the state government. So how would now between the federal and the state government, how would the ministry plan to work with subnational governments to create a holistic action plan and particularly to mobilize capital? Now, how do you see critical barriers and successes? What could be some of the milestones that you are looking at? Over to you, Abhishek.
Thank you, Namita ji, and it's nice to see you once again after our Mumbai workshop. As regards the policy perspective and the dearth of financial availability, I will address this particular issue from two angles. One being the international, second being the national one. From the international perspective, we have seen, there has been claims, but the scope, scale and speed of finance, especially climate finance towards the adaptation, has not been up to the mark as of now, compared to the requirement of the developing countries' adaptation initiative requirements. Now, this would pertain to the quality and the quantity of finance, because adaptation, as of now, primarily have been seen as an initiative that needs the government or the public participation to the greatest extent. Because we have seen there has not been sufficient private participation in adaptation initiatives. Coming to the domestic participation, domestic perspective, if I may, this requires a greater participation from the private sector. Now, how to ensure private sector? Now, I myself being what I would like to call a neo-classical Keynesian economist, which will have an amalgamation of both the classical and the Keynesian ethos of economics together. Requirement of setting up a market system for adaptation is very much required. Now, how that can be ensured? Why the common idea prevail that prevails is that the adaptation doesn't have a private sector participation and cannot have a market system mechanism fully functional. This is because of one very important issue, that is the information asymmetry. Now, how this information asymmetry affects? By creating risks for the private sector. If we can address the information asymmetry, which can ensure that there is already existing profitability perspective, profitability opportunity from the private sectors, that will ensure the private sector participation to the best of extent. Now, let me give you an example one example that is very close to me is about resilience in mitigation, because adaptation and mitigation cannot go by being mutually exclusive. Now, what is resilient mitigation? If we think about a mitigation aspect, for example, maybe a solar panel created to generate renewable energy. Unless and until we ensure that those solar panels are resilient to the climate vagaries existing there, and we see that the climate requirements, the action required to combat the climate vagaries are changing in a very dynamic perspective. So that resilience component is a very important area that has to be ensured. Now, that itself creates a market possibility for the private sectors to participate. So this is an information asymmetry that exists in the market, that there cannot be a resilience component in the mitigation. But if we think about it, if we can devise our policies, if we can proliferate the information that no, the information asymmetry is the barrier, and there can be definitely a profit motive, profit incentive for the private sectors to participate in the resilience, that can ensure the private sector's participation and the greater financial participation as well. Now, coming to my previous speaker, Charlotte, mentioned the grant and public finance. From India's perspective, what I can say that India has been taking up the adaptation initiatives based on primarily public finance from our government schemes, from our state level participation through their finances. But the grant element from the international finance has been very abysmal. Now, as you put the question, how we should engage more with the subnational level, our national adaptation plan, even before the national adaptation plan, we had a national action plan on climate change and the state action plans on climate change, which is a bridging system between the states and the center, the union and the federal governments, which has ensured the adaptation and resilience factor has been taken into account, the greater ambit of climate policy within India. And the national adaptation plan, though it's at the very initial level, it will have definitely a stakeholder consultation with concerned states, with the requirement of the states. Also, it would require better stakeholder consultation with the local level governments, because local level governments would be an important component, as we see that India is a huge, diverse geoclimatic entity which has a very diverse requirement for adaptation. So a better consultation through the process and the private sector participation in together can have a better solution towards the adaptation and the resilience requirement for finance as well. I'll stop for the time being here, and if there are any follow-up questions, I'll definitely happy to answer them.
No, thank you, Abhishek. I think this is a very important point that you brought in terms of the federal or the national government and the state government. And yes, India indeed was one of the early adopters of a climate action plan for at the national level and at the subnational level. I think that, I'll pick up a point that you spoke about was the quality and the quantity of finance. I think that's a very important thing, and relating that to the market systems, and make my way to, Matthew. Matthew, my question to you in relation to what Abhishek said is then from an investor lens, to be able to accelerate, investments into nature or adaptation, what do you think should be the regulatory signals, or what should be the specific policies that would, really enable investors to look at these kind of investments? Over to you, Matthew.
Yeah, thank you, Namita, and thank you everybody for putting this together and including me in the panel. It's an honor to be here. Yeah, so for everybody on the call, just quickly, ISF Advisors, we are, for those of you who don't know us, we are a financial and strategic advisory firm. We work primarily with development actors to help create better strategies, financial vehicles, and research around catalyzing more investment into agriculture within emerging markets, with a heavy climate lens. And so, Namita, to answer kind of your question, two things I think primarily come to mind when thinking about how the government can create push and pull incentives for commercial investors around climate adaptation. The first is, I think, in terms of kind of repurposing agricultural subsidies. So what we see is, there's about $1 trillion circulating around every year that goes towards agricultural subsidies, most of which is going to conventional agriculture, mainly that have kind of high CO2 footprints, such as row crops or dairy or meat, right? And so we see a lot of government subsidy going into these heavy CO2 agriculture industries. There's an opportunity there, I think, to pivot those subsidies to more sustainable agriculture practices, whether that's subsidizing directly those practices, subsidizing restoring degraded land, or whether that's using government funds to kind of expand credit or access to insurance for sustainable policies. I think there's a lot of work that can be done on the government side to help direct subsidies more towards sustainable agricultural practices, and therefore signal to the wider market that the government is investing in these things, and this is where the industry is going. That also helps to reduce a lot of risk for commercial investors. That's kind of the first thing. And then the second thing is I agree with Abhishek wholeheartedly, and one thing I think that the most resonated with me from what he said is there is this information asymmetry. And it's addressing that information asymmetry, but I think in a more practical sense, it's more just having more standardization and addressing confusion. So I think what we do when we speak with private sector investors, even those that are focused heavily on investing in climate adaptation in emerging markets, when we speak with a wide range of investors, we'll speak with 10 investors that are investing in climate adaptation, and we'll get 10 different definitions or 10 different taxonomies of climate adaptation, right? And so I think a big thing is where governments can go is more effort around standardization of those taxonomies and definitions, and then working with investors to help standardize that across their portfolio. So one piece of work actually that research work that my colleagues did was kind of calculating the financial flows to climate adaptation globally. And actually what they found was, even though a number of investors weren't labeling their investments as climate adaptation investments, there was actually more climate adaptation investments being done that they just didn't know were climate adaptation investments, right? So I think standardizing those definitions will go kind of a long way towards helping investors who want to invest in this sector. Similarly, kind of in that same vein, I think what we see in terms of climate adaptation specifically, which is less the sense in terms of if we're speaking about CO2 mitigation, is that adaptation tends to be highly localized. It depends very much on the local context, the local risk factors, et cetera. And what we've seen from investors is a need for national, but also local governments to help kind of demystify what those climate adaptation needs are in specific areas, right? So I think there's a lot of work that can be done from the government level on doing climate risk assessments on a regional level, and then helping to communicate those investment needs in terms of the interventions to address those climate risks, do a better job at communicating those to investors, so that taking the guesswork out of the investors into what type of interventions are financeable, and what type of climate interventions are needed in a specific region to address those specific climate risks. So those are the kind of the two buckets of areas: repurposing agricultural subsidies, and then essentially demystifying climate adaptation at a local level that I think can definitely help the sector.
Great. Thank you. Thank you for that. I think demystifying climate adaptation is one of the important things also from asset managers or bankers standpoint, because asset tagging would actually reveal what kind of portfolio an institution holds. And that gives me a good segue into going to Kavita. Kavita, who's dealt in these matters for many years now. From your perspective, how do you think banks and investors would look at this, and what do they really require? You've been interacting with banks as a part of the principles of responsible banking that UNEP-FI has set up, and it comes down to when we connect information asymmetry, it comes down to tools. So specific risk assessment tools, methodologies that you believe financial institutions most urgently need to evaluate and to channelize capital. So could you please share some of the examples of the UNEP-FI's initiatives of addressing all these needs? Over to you, Kavita.
Sure. Thank you, Namita, and thank you, Optus ESG, for having me for this discussion. Really delighted to be here today. So for those of you who are new to UNEP-FI, UNEP-FI is the finance initiative of the United Nations Environment Programme, which brings together a large network of banks, insurers, and investors globally, which collectively catalyze action across the financial system to deliver more sustainable global economies. So we work with more than 500 banks and insurers with assets exceeding $100 trillion together to facilitate something we call the UNEP-FI's Principles for Responsible Banking and Principles for Sustainable Insurance. So financial institutions work with UNEP-FI on a voluntary basis, and we support them to apply industry frameworks and develop practical guidance and tools to position their businesses for the transition to a sustainable and inclusive economy. So the Principles for Responsible Banking were established to align the banking sector with the United Nations SDGs and the Paris Agreement. In fact, this week it's our 5-year anniversary. So in response to your question, and I think all that my co-panelists have spoken, and to the topic of today's discussion, I would like to highlight the work that UNEP-FI Principles for Responsible Banking, or PRB as we call it, has done on nature guidance for banks. So this was guidance co-developed with 34 signatories or members to the PRB from across the world. This guidance actually assists banks to take action through portfolio-wide targets in support of the policy goals established by the Global Biodiversity Framework, the Kunming-Montreal GBF, as we know it. So we recognize that nature is an emerging impact area in terms of available tools and methodologies. And obviously there is a lack of robust science-based sectoral pathways on nature, limited availability of data at the issuer level, and then also a lack of universal metric to measure nature. Unlike carbon, we have GHG emissions, but in case of nature, we're still looking for maybe multiple metrics amongst other challenges. And this requires banks to adopt a phased and pragmatic approach to target setting on nature. That said, I think banks have a key role to play in achieving the 23 targets underpinning the goals specified within the GBF, in part due to their activities in high impact sectors, and in part due to their high levels of financing in emerging markets and their power to direct financial flows towards nature positive activities. So the guidance that I spoke about, which we've co-developed with banks, for banks, outlines key steps to embedding nature related considerations in their lending and investment businesses. To start with, banks need to assess their exposure to nature-related impacts and dependencies, risks, and opportunities. I think we touched upon all of these in the last 20 minutes or so, for which the paper outlines the tools and approaches available for banks. This includes reference to other frameworks and guidance, as well as a step-by-step approach in line with the TNFD's disclosure recommendations and the LEAP approach. The LEAP approach is basically locate, evaluate, assess, and prepare. Guidance is then provided to map exposure to high impact economic sectors, or high priority sectors as we call them. Following on from this, detailed guidance is provided so that member banks can one, understand the context and align with GBF and other regional frameworks and policies, such as the implementation plans of their own countries, like they're called NBSAPs, the National Biodiversity Strategy and Action Plans. Second, I think what we've said is integrate nature within their policies and processes, which includes mainstreaming nature within the organization via policies, processes, capacity building, even culture and governance. And then engaging with clients very actively to help them also embed nature considerations in their businesses. Then mobilizing financial resources to direct more finance to nature. And then obviously also engaging in advocacy work and developing partnerships that encourage a wider transition to nature positive activities. So within each action that I just outlined, recommended actions or sub-actions and sample targets are provided, including headline targets where relevant. And then these can be fine-tuned and improved over time as banks gain more experience with this topic. I must say that this guidance is non-prescriptive and has adopted a flexible and progressive approach to target setting, prioritizing countries' own targets, and metrics as far as possible. It also takes stock of the fact that certain banks have already made significant progress on the management of climate and some nature-related risks and impacts. It also recognizes that other banks in developed and emerging markets are still at the start of this journey, and countries are all currently updating their NBSAPs following the endorsement of the GBF. So the guidance is available on the UNEP-FI website. I think I'll try and post it here. We also launched a case study supplement, which has very interesting case studies of banks already embedding nature-related considerations in the form of internal policies and processes. There are those 4 action points: internal policies and processes, client engagement, portfolio composition and financial flows, and then advocacy and fostering partnerships. I'll post the link on the chat. Let me just try to do that, but I hope that partially answers your question.
Yeah, thanks a lot, Kavita, for that very comprehensive, input. And congratulations on the 5-year anniversary of
Thank you.
PRB, and I'm very close to it because I was a part of the architecture team 5
Yes.
years back when we put it together. So I think that was a breakthrough for the banks to, use
Yes.
some kind of guidance, and it's very useful. And I would urge everybody to please go to the UNEP-FI website and take a look at it. I will move on to Larissa now. Larissa, there are the panelists ahead of you did speak a lot about data and the lack of granular data or the divergence in valuation methodology that affects the ability of finance to go to scale in nature-based solutions, particularly in agriculture, or enable to really fathom the ecosystem services benefits, etc. From your perspective, what are the key metrics that we are really missing here, and also standards that we need to look at from governance level, because that's also an important aspect that needs to be brought in. So over to you, Larissa, for that answer.
Yeah, thank you for having me on this panel, and warm greetings from Berlin. So I work for a think tank that conducts action-oriented research in the areas of nature-based solutions, but also land governance and food systems, including agriculture across Africa and India. And regarding data, yeah, I think it has been said by many, if not all, panelists that we do lack data, and this, of course, is a barrier for financing. So to have robust data, but also the context-specific knowledge about the performance and effectiveness of nature-based solutions, or NBS, are, of course, essential, because without them, on one hand, we cannot fully grasp the benefits, the breadth of the benefits they deliver, but also, and what I think is very important when it comes to risk, we must also know more about the potential trade-offs that they may bring. So this knowledge, it's just not informative, but it's also really foundational for designing the right framework conditions for scaling up nature-based solutions, and understanding which investments will have actually the greatest impact in which area. So without such comprehensive data, we cannot really make the assessments about the cost effectiveness. And then, of course, it becomes very difficult to check finance and also justify scaling up of certain initiatives. what I experience in our research is that we know fairly well about certain measures like water and soil conservation to improve ecosystem services for plant and crop growth, for example. But often what we are lacking is knowledge about the right mix of measures. That is very context specific. This being said, I also want to flag that lack of data should not be an excuse for prompt and large-scale action, because I think that is also often happening, like all this call for more data and more data. It should really not delay any action. So ideally, I would have collection of data by the people implementing nature-based solution, by the local communities, but alongside decisive and fast implementation. Now, as regards standards, one major challenge we face, and which has been mentioned also by others today, is the absence of universal standards for nature-based solutions, because this is so essential, because the NBS concept has also been misused, leading, for example, to large-scale tree plantations that offer little or even harmful value for biodiversity, and in some cases where we also saw displacement of local communities, so infringement on human rights. So of course, this would be then a huge risk. And for that reason, it's so essential to have standards for NBS. And to give one example, we have the IUCN Global Standard for NBS that was launched in 2020. I think it was a significant step forward. It was developed through participation of diverse stakeholders, and it addresses the two critical issues that I've mentioned before, namely ensuring human well-being and the respect of human rights, as well as promoting biodiversity. So yeah, I would like to close with that. Thank you.
Yeah, thanks, Larissa. I think talking about the right risk matrix is very, very critical, and lack of data should not be an excuse. However, adaptation projects do tend to have multidimensional benefits, some preventing future losses and some direct benefits to the community. Now, this makes it difficult to monetize, and like, for example, preserving wetlands can avoid floods, but this benefit is difficult to quantify or translate into returns for investments or for investors. And I think how do you then look at the credit worthiness? And therefore I would like to go to a practitioner, and that is Lashlin. Lashlin, my question to you is, nature-based projects, like I said, often also have long gestation periods, higher transaction costs than conventional investments. And therefore, I've seen many a times the inclination is to just go with the proven models and just put in capital there because there are set ROIs. I would like you to highlight how Finance in Motion approaches the valuation and the risk assessment of such projects. What are the kind of strategies that you employ? How do you look at this long-term investment space? How do you make it more attractive actually for potential investors while also looking at lowering the startup costs? So over to you, Lashlin.
Thanks, Namita. And thanks also for Octus and the co-panelists for the time today. I'm Lachlan. I'm the head of climate and nature work and investing work at Finance in Motion. Probably not a household name, so worth saying we're an impact asset manager based out of Germany. We're managing roughly 4 billion euros in assets under management, and that's exclusively in emerging markets, about 40 emerging markets by now. And sort of implicit in the name, but everything we do is sort of dedicated to delivering positive outcomes for society or for the environment. And maybe just to give a kind of a breakdown, about a quarter of what we're doing, so roughly 1 billion euros or so, is focused on, say, nature investing with a strong climate lens, and another billion or so, another quarter, is focused on more sort of classical energy and climate investing. So we have this experience of doing both and looking at both. and sort of seeing the differences there and how the market responds and also how investors respond to this. And maybe then nature is a very like broad term in a way. So I just try to narrow this down a little bit, which is, you can imagine some things we heard about an example there from Namita around, maybe wetland preservation and sort of nature conservation sort of projects at maybe one end of a spectrum. And then there are other things at another end of a spectrum that are very much about just reducing the drivers of biodiversity loss. And these are things in the sort of agricultural space, aquaculture, downstream sort of value chains of this, parts of forestry, parts of tourism have to be tackled and they have to be really transformed. At the same time, these are also sectors that have established business models that you can realign. Generally, the solutions here are reasonably well understood. There's maybe already partial penetration of these solutions in local markets. So, for example, certain kinds of certified and labeled produce, they've got built-in sort of avoided deforestation standards. They've got built-in requirements around the nature and type of production and sustainable production activities. Or they're also just sort of reasonably well understood individual measures, right? So, agroforestry activities, shaded production of say export crops, certain kinds of, even in the sort of feed in the cattle or livestock space, silvopastoral activities and things like this that are understood but just not prevalent yet in local markets. And so, in a way, building on things that are there and scaling those up is one of the things that we do, and it's obviously more compatible in an investing perspective to start like this. Of course, we need solutions at the other end of the spectrum, but not everything will have an sort of an investment solution in a more classical sense, and some things will have different kinds of solutions, public solutions. I think there's just important to recognize that different parts of that spectrum will have very different solutions. And so there's also, I think, good experience in these sort of productive sectors of showing the win-wins, right? You can really show people that there's improved resilience. You can show them that there's better yields, maybe better product prices if they've got labels. And you can show then, climate action to a primary producer is really much a co-benefit, right? That's not the selling point for them, but it's this is a powerful way to work. And another thing, just to maybe you mentioned a bit about incubation cost or sort of time to develop projects is an issue, but I would say it was something that Matt mentioned already, and I think Kavita mentioned a little bit as well around. It's very much a disaggregated challenge in the nature space. So when we think about energy and mitigation, right, you can imagine maybe sort of these sort of point sources more classically. It's certain kinds of bits of infrastructure around energy production, heavy industry, the way you produce goods, but even the way you regulate the performance of goods, right? Just great standards on sort of minimum performance of certain kinds of consumer products is really important. And you can solve those things quite centrally sometimes. I think in the nature space, it's often harder, right? You're dealing with drivers or sort of like the key drivers of nature loss are very much at the very fringes of value chains. They're these sort of tens and hundreds of thousands of primary producers, and often even not in a formal value chain, right? And so if you're an asset manager, you're an investor, and you're looking at solving that problem, it's really difficult to reach into this very granular level of an economy. The way we do that through the funds that we have is that we often work with local financial institutions. They're embedded already in the sort of national fabric, and they're lending already to these sorts of clients. They have agricultural portfolios. They actually have a history. They understand indirectly. They understand climate risk, right? They've been struggling to lend to agriculture often for the longest time because it has climate risk in it. They just didn't really call it climate risk, but it was, an unreliable business model often. And so explaining how this will evolve, but also explaining the kinds of mitigants that can be there. So showing that you can make a sustainable agricultural client a better client for them, a lower risk, they get better portfolios. That's very powerful with local banks. And so we do a lot of work with them, and then they have their client base that they can open up. So showing them how to talk to their clients, helping them do outreach, raise awareness with their clients is a very effective way of like tackling this disaggregation challenge, I would say. So these are, I stop here, but this would be a couple of examples of how we're thinking about this nature issue in the climate space.
Thanks, Lachlan. I think you took me back to 2008, maybe, when the renewable energy sector, wind especially, was just about picking up, and how investors and financiers looked at it in terms of nascency and customized approaches that you spoke about. I think that's how I think that's where nature is, or nature-based financing is at its life cycle graph, maybe. Local partnerships is a very key point that you made in terms of the knowledge that is sitting there with institutions who are grappling with the challenge or in the middle of the challenge, yet going out and doing that financing. And then how do you work with them? How do you partner with them to deploy that capital? Becomes very, very interesting to look at. I see that we have another half an hour to go, another 30 minutes to go, and I will go into the second round of questions. I would request each of the panelists to limit their interventions to about 2 minutes, because I think I've seen some questions from the audience that I want to go to, so that we can address everything here. Let me go to Abhishek. Abhishek, you did mention about international capital, and you did mention about support from international entities as far as scaling up or even investments into nature-based projects, which is today showing limited bankability, and it's because of insufficient risk matrix or opportunities out there. I would like you to throw some light and dwell upon how can partnerships with multilateral development banks, because that is something that we are seeing a lot of capital that's coming from MDBs, could be strengthened, restructured at country levels, and they have this whole component of technical assistance. So how do you see innovative policies, tools, mechanisms playing a role, and to make projects bankable? Over to you, Abhishek. And that's from a policy standpoint, from a government standpoint.
Thank you, and it's a very important question as well. The partnership with the MDBs is very crucial in the sense that, as you mentioned, the technical assistance. Now, the roles that MDBs can play even better for a country like India, as mentioned, is to create the capacity building. A collaboration with the government to create the capacity building, especially on the subnational levels, where the information, as I circle back to the information asymmetry can be addressed by these capacity building initiatives that the partnership can create. Because first, MDBs bring in with their experiences, their know-hows, their capacities, their technologies. And this would enhance the actionable capacity of the implementers of climate action, especially from the adaptation perspective. Secondly, there can be platforms that can be devised by the MDBs for the developing countries where we can share the best practices, because India has certain best practices in some of the adaptation initiatives. Some other developing countries might have been exercising a better practice on certain other aspect of adaptation initiatives as well. Third point that I would like to mention is that there has to be knowledge sharing through the developing country perspectives, and this would obviously, that platform itself will serve for the knowledge sharing system as well. And maybe a fourth point that we can think about is the innovative financial instrument design. Because if we see for the local administration, the local level adaptation requirements, the financial capacity is constrained for the local level administration for the other developmental imperatives. So if we can devise some sort of innovative instruments which can bring in more private sector finance, more international finance for the local level governments, that would, of course, ensure a greater holistic participation for the adaptation initiatives as well. So these 4 points I would like to address for your question. Thank you.
Thanks, Abhishek. In fact, at the IMF annual meetings, there was a MDB platform. So 10 large MDBs, including the AIIB, ADB, and others, have come together to create a platform to look at climate finance. And I'm not sure if nature-related finance is one of the focus, or at least how they're looking at nature. But I'm sure that these kind of large platforms would help. Moving on to Charlotte, there have been a lot of focus on, while we talk about sectors as far as nature investments are concerned, water becomes a very key aspect of developmental agenda, right? And water financing, therefore, it has its own importance at a different level. What market shaping mechanisms or policy instruments do you believe hold promise for scaling up investments in sectors like water or land use, and how could these be tailored from a developmental agency's perspective, given the regional differences that we deal with in different geographies, right? Over to you, Charlotte.
Thank you. So I think it's quite a broad question because there's so many areas of policy and regulation that you could be looking at. I come from the financial systems development side, so I focus on sustainable finance policy making, where GIZ has worked a lot on supporting our partner countries in developing taxonomies. And I think so taxonomies are basically documents that define for economic activities which criteria they have to fulfill to be considered sustainable. And they're meant to drive transparency and comparability in the market. So I think it picks up on what Matthew said about the need for standardization. We support a lot of our partner countries where the agricultural sectors are a massive contributor to GDP, to include agriculture in their taxonomies as well. So it defines best practices for sustainable agriculture or sustainable forestry so that both producers and investors know what the standard is. And I think with respect to the regional differences that you mentioned, in the development of those criteria, it's important to build on what is already there. So existing guidance and regulation from the ministries or regulatory authorities. So for example, there might be guidance on what an environmental management plan looks like or which fertilizers should be used. And another important factor that we've come across in our work is the need to tailor these criteria for smallholder farmers as well, because they make up such a large part of the agricultural sectors in our partner countries. And I think beyond sustainable finance taxonomies, there's a lot that policymakers could be looking at. Some of them have already been mentioned today. So for example, providing clarity on carbon credits and the development of those markets, securing land tenure rights, which is often an issue with nature-based solutions where we see issues with land grabbing or expropriation, and then also reducing asymmetries on the subsidy front. So making sure that regenerative agriculture isn't has the same access to subsidies or even more access to subsidies than conventional agricultural practices.
Great, thanks for that. Yeah, I think there's a huge opportunity here that gets created. And let me go to Matthew. Matthew, I did speak about quantification and monetizing of ecosystem services or biodiversity benefits for investors. In your view, what are some of the innovative approaches that can be used within fund structures to address these challenges and bring out the opportunity to draw in more capital? Matthew,
yeah, it's a great question, and I think the ability for funds and investors to monetize payment for ecosystem services and biodiversity credits is an exciting kind of future opportunity. I think that we see that as a really exciting area for development. I think what we see today is that most of the investors and funds out there in the landscape aren't necessarily monetizing those biodiversity credits or payment for ecosystem services. They're not monetizing those aspects just yet. So we see a lot of monetization of carbon, obviously, but don't see so much of these other kind of aspects. What we do see is that when addressing those, most investors and asset managers are kind of using those as secondary positive externalities, either as a way to kind of increase the value and or the attractiveness of the carbon credits that they're generating, or in order to attract other impact first investors that are looking for those types of impacts, right? So I think kind of what we're seeing over the landscape is it's still kind of a nascent industry, and investors haven't quite yet figured out how to monetize those, and the market necessarily isn't quite there yet. But if we look at kind of insights that we've taken from carbon and how maybe that can apply to biodiversity credits, et cetera, I mean, first, what we're seeing is a kind of a shift in terms of investment funds towards longer fund structures. So, nature-based solutions take much longer to monetize than kind of your typical VC models, right? So we're looking at funds that are extending the fund life. So the kind of classic 10-year model is not fit for purpose here. So we've seen funds that go all the way out to 15 years, but we're also seeing investors experiment with more open-ended fund structures, investment companies, et cetera. So that's kind of one key insight that we're seeing. Another, I think, of what we're seeing is kind of, there's essentially two types of investors for carbon credits. So there's one set of investors that are looking for financial returns from those carbon credits, looking to essentially speculate on the price of carbon. And then the second is those types of investors, mainly corporates, that are looking to then acquire those carbon credits, offtake and retire them. Right. And so what we're seeing when we speak with fund managers is that there's a need for kind of ring fencing and separating those two types of investors, to ring fence funds, because having those two types of investors within the same fund structure often creates conflicts of interest. Right. So we're seeing more and more investors create separate pools of funds for investors with different objectives when it comes to carbon credits. And then lastly, just to point out a couple of interesting models that I think most relevant now for carbon, but can definitely set up interesting models for the future for monetizing biodiversity credits as well. First is some of these models that have more integrated approaches, so they tend to combine market access in addition to access to finance. So a good example of this is Rabobank's Acorn platform. So they have a platform for, which I'm sure most of you know, for commercializing carbon credits through agroforestry models. So they have that platform that provides that conduit for off-takers to buy those credits. And then they also have technical assistance as well as a sidecar facility, a fund that then provides the financing for the implementation of those agroforestry models, right? So they have a very integrated approach that helps get those carbon credits, from agroforestry models all the way to market. I think that'll be very relevant for biodiversity as well. And then the second models that I think are interesting or worth highlighting are these RISCO models, which many of you Kavita, you might have probably been working on these extensively. But these are essentially models where a company will regenerate a mangrove or coastal restoration, and they work hand in hand with insurance companies to help monetize those benefits, right? So the decreased risk results in kind of decreased risk for the insurance company, and therefore there's a financial benefit to that they can then monetize from the insurance company. So it's working very closely with the insurance companies to help make those that risk reduction very tangible and have financial returns from those risk reductions. So those are two interesting models, both kind of these integrated models like Rabobank's Acorn, but then also some of these models like RISCOs that are working with insurance companies to help monetize that risk reduction.
Thank you. Thanks, Matt, for explaining that so well. I'll go on to Kavita. Kavita, my question to you is that you have worked in the water sector as a part of your World Bank role, and I would like you to contextualize that in terms of how UNEP-FI has looked at water, helping financial institutions to better understand and quantify the interconnection or interconnectedness between circular economy principles, climate, nature conservation and water security when it comes to lending and investment strategies. Over to you, Kavita. I would request you to.
I'll try and be as brief as possible, but I think this is, again, a very important piece of work UNEP-FI is pursuing. And the genesis of working on the topic of the nexus between circular economy and environmental and social impact is the increasing realization of the need to start recognizing the interconnectedness of it all, and the need for banks to not address these separately, but to leverage the synergies and operationalize their nexus to accelerate impact. I think you mentioned, Namita, that resource use is at the heart of the triple planetary crisis, and that 55% of GHG emissions are associated with the management of materials, and 45% come from the production of goods and the energy required. So these figures highlight the critical role that resource efficiency and circular practices can play in climate mitigation. Talking of circular economy, nature nexus, I think we may have heard about the IPBS on biodiversity and ecosystem services, which highlights how circular economy tackles the key drivers of nature loss. So it reduces the amount of land needed to provide resources to the economy, which is addressing changes in land and sea use. It manages renewable resources for the long term, addressing direct exploitation of organisms and natural resources. It reduces GHG emissions across the economy, so it's addressing climate change directly. It designs out pollution at every stage of a product's life cycle, so it addresses pollution. And it also designs out the waste on which invasive alien species, as we know that the topic, can be transported to new ecosystems. So similarly, circular economy also has interlinkages with other environmental and social impact areas, which can also be leveraged. And towards this end, UNEP-FI has again very recently launched a first of its kind and the first in a series of guidance on circular economy as an enabler for responsible banking. And this guidance was co-developed by 18 member banks globally with active support from industry and academia. And as part of the first phase of this series, we launched 4 reports. The first paper illustrates the nexus between circular economy and climate. It also includes case studies showcasing member banks already integrating circularity into their business models. The second one delves into the circular economy climate nexus, and circular solutions for achieving climate targets, providing banks with practical insights and actions to integrate circularity into their climate transition plans at a sector agnostic level. And then the third and fourth papers are basically sector-specific supplements for the buildings and construction sector and the textile sector, both of which are high emission and also have high circularity potential. So the guidance is a first approach for banks to manage interlinkages between circular economy and environmental and social impact, like I said, and sector-specific actionable recommendations for banks provide guidance to integrate circularity in transition plans to achieve sustainability targets within the PRB framework, by both addressing risks associated with linear and circular business models and also leveraging opportunities by integrating higher circularity, which drives superior risk-adjusted returns and provide financial products and services which support circular business models. So I think I would recommend that you read the whole approach that we have defined in greater detail in the guidance, and also it explains actions that banks can take to integrate circular solutions and opportunities in the bank's transition plans. We have just commenced phase 2 of this work, during which we plan to focus on additional sectors to build on the circular economy climate nexus, and then also start with circular economy nature nexus, then circular economy pollution nexus, and also the nexus with healthy and inclusive economies. The final point I think I would like to make is that while this space is still nascent, regulation and policy is very fast evolving, and local and regional governments are establishing and implementing national policies to support the development of circular business models, resource efficiency, as well as infrastructure for waste collection and treatment. Also, I think extended producer responsibility measures, resource efficiency standards are being introduced. And in the future, we believe that a further rise in regulations and policies to not just incentivize a circular economy, but also disincentivize a linear economy are coming up. So I think it's important for banks to gear up and initiate crucial first steps by leveraging existing tools, methodologies, and frameworks which are available and adapting their strategies accordingly.
Great.
I'll
Thanks,
post
Kavita.
this one on the chat as well.
Yes, I think socialization of some of these aspects is very important. Let me quickly go to Larissa. Larissa, very briefly, Kavita did mention about policy interventions and there is a lot of partnership that is required or consensus that is required when it also comes to not looking at things in isolation, and data sits at the core of this. Would you elaborate on very briefly on a couple of global best practices where you've seen this across markets as success stories? Over to you, Larissa.
Yeah, thank you. I would actually like to give an example from our own work when it comes to data and data collection that is so much needed, as we have talked about today already. So we work in southern Maharashtra in India with an NGO called Swapicom in the water sector. And there we conducted field studies on the collection and use of data in groundwater and surface irrigation projects. And what we found was a recurring challenge that the data collection and analysis is often managed exclusively by the technical project staff, with minimal involvement from farmers, from the users, from the implementers of nature-based solutions, actually. And this is a big problem. And also, as Abhishek was saying, what we really need is the capacity building at the sub-national level to close the data gap. So what we then set out to do was to develop an app that we named ePowers, that would empower all the water users within the irrigation scheme in the sites to collect the data. And this app we co-designed with the intended users, so based on their needs. And now what we see is that, as I said, this app empowers the local water user associations to manage the resources more efficiently by giving them direct access to broad scale and timely data that is collected by hundreds of the association's members. And though we are still in the process of rolling out the app, our monitoring has already shown high levels of interest from the communities. And the reason for that is very clear, because this type of data collection process reduces the transaction cost, so making the entire water management initiative far more cost effective, and thus, I believe, also more attractive for financing, right? So before the app, farmers had to submit their irrigation water demands on paper, often walking long distances, and now this can also all be done with just a fingertip. So this is just one example of how data collection can be done in a participatory, cost-effective, and also sustainable manner. And here I also want to flag that when we speak about data and data collection, data availability, of course, the cost efficiency here is very important, but also from our perspective, to transfer really like the agency to the local level, to the people that actually implement the nature-based solutions on the ground. And so that here we can also support the sustainability of such initiatives. Thank you.
Thanks, that's a very good example. And I would like to quickly go to Lachlan. Lachlan, my question to you is, you do work on mandate development. What are maybe a couple of examples of nature-based investment products that you think, or vehicles that can go to scale in this space? So over to you.
Thanks, Namita. Yeah, and maybe I also try to link in a couple of questions that I saw in the Q&A box coming from attendees around, are there examples of aggregation and that working for smaller projects, and also are there examples of blended finance sort of success stories in the nature space? And so yeah, keeping in mind that the two things I had started with before, which is that I think you need to engage with sectors that are impacting biodiversity loss and sort of transform those business models. I think that's one way to get to scale, because they're at scale today. They're changing the planet at scale today. And also this need to sort of mainstream things with financial institutions and change the way they think about this and what they expect of their clients. That has to happen, right? They're the largest source of capital to emerging market economies. You have to partner with local banks, or you won't get there. And so that already, I think, picks up this topic of aggregation, right? If you can find local financial partners, local financial institutions, they are aggregators, right? Just as a fund is an aggregator for private investors, at the local level, local financial institutions are aggregators. So I think that's already happening. But this is all very much on, say, like the sort of like in asset management speak, the asset side, right? Like, how do you change activities on the ground? But if you want to think about the so-called like liability side, where do you raise capital from? Like, how do you attract more capital? And also you need to scale, not just how do you deploy financing in an effective way, but how do you raise financing? And so there are also, long track records and success stories in the blended finance space of doing this, right? You have to understand private investors have a certain fiduciary duty. They want to understand they need to see something that works for them in terms of a certain risk profile or a return, or has certain minimum volumes, or has a sort of a level of liquidity available to them. Like, these are all just the reality of the asset management industry that manages everyone's pensions and holds on and invests funding ready for insurance claims, etc. Right? This is the big bulk of capital that's available that you have to find fitting products for it. And that blended finance model has worked well for a longer time. And the majority of what we're doing is in a blended finance space, right? So we having then public investors in different parts of a fund, a public investor, say, in the bottom of the fund, if I can call it, so the junior tranche of a fund, and they're bringing really risk capital. They're prepared to take risk because they want to deliver outcomes, and they're willing to take even the first loss, right? They kind of give this risk cushion for the investors above them, so to say. And then that means that you can, in different ways, bring private investors in a de-risked way. You give them a product that has a more familiar risk profile. You give them a product that fits their needs, but you also then are bringing them to geographies and topics that they would just never normally be able to think about. And you're creating a size of funding that allows them to engage as well, because this fund is aggregating lots and lots of things that are happening in multiple countries, and also therefore diversified. So that track record, for example, we have a large nature-focused fund in Latin America that we've operated now for close to a decade. And a few years ago, we could replicate that in sub-Saharan Africa. And you change things about it, and the fund does different kinds of investment work in that set of geographies. But that ability to sort of take something, replicate it, and grow it to a meaningful scale of together now at or close to €1 billion of capital that's available to deploy. Or is deployed. That's very powerful. So it doesn't have to be blended finance. We also have nature investment vehicles that are operating on a different model and a kind of private equity model. But this only works in certain sectors. So it's very much finding the fitting model for the challenge that you're tackling. But this blended finance space, I think, has really strong opportunities to grow this in a meaningful way. I allow myself just 30 seconds on this idea of biodiversity credits, if I may. I think that's really interesting. But if I look at, say, voluntary carbon market, it's had a decade of experience building on more than a decade of compliance markets of CDM, and it's still growing to interesting but not world-changing sizes. And I think we should expect something similar from biodiversity credits, right? It will grow, it will be meaningful, it will do important things, but it won't solve the problem. And we have to think of, other models that don't rely on credits in very, very, very many parts of the economy to get this done. So I just leave that as also a thought.
Great. Thank you very much. I think that was very, very insightful. Overall, the panel discussion was insightful. I have been looking at the questions, and I think most of it has been covered in different responses by the panelists. And thank you very much. And I hand it back over to Harshali to close the session. Thanks a lot.
Thank you so much, Namita. And to all the panelists, that was a very insightful discussion. I think I learned too much to a point. We have approached the end of the webinar, and I hope you enjoyed the session as much as we enjoyed hosting it. These conversations have been very riveting, and they have provided us with a lot of food for thought. Please do keep an eye out for the recording of the webinar and an event report online on LinkedIn. And with this, I would like to thank Climate Week New York for allowing us a platform to host such insightful discussions, and our partners as well, ADFIM, ADFIAP, and IORA. And thank you so much for joining us today. Have a good day. Thank you.
Thank you.